So in this video, we're taking a look at some potential causes or catalysts for the next recession. Now, look, the economy is this beast. It's incredibly difficult to accurately predict what the economy is going to look like in 6 months, in 12 months, in 10 years. It's difficult to do that. And I would argue that anybody who tells you that they can absolutely tell you that we are going to enter a recession on September 28th of 2020. Anybody who's telling you that, just be very wary of them and understand that maybe they have some type of ulterior motive. Maybe they're trying to sell you gold because they own a gold exchange. There's a lot of reasons why people are going to do some fear mongering, trying to tell people that a recession is coming very quickly. But at the same time, it's important to understand that, look, we've been in the longest bull run of all time. The economy's been growing for 10 years now. We've seen some pretty good economic times, or at least on paper. And so it's important to realize that, look, recessions occur, and they recur usually more often than what's happening right now. So it's important to prepare for it. We are going to discuss some different investments and talk about what I do with my portfolio. But at the end of the day, look, this is just a video that I'm making for the internet here on YouTube. So this is not financial advice. I am not an economist, but these are some ideas and some things that I've been thinking about when it comes to the economy, some red flags, but to really kind of just dig into this now, let's just get started. Make sure you subscribe, and let's get started with this video. All right, so one of the first things that I think we need to understand is that predicting the economy, like I said, is very difficult to do. I sort of kind of compare the economy to the weather, where we can kind of have an understanding of maybe we know where it's going in the next couple of days, but as a whole, it's difficult to predict the weather a year from now. It's difficult to predict that a tornado is going to hit this exact town 2 years and 342 days from now at this exact time with this exact force, right? So just like the weather, the economy is something that we can't necessarily control. We can try to do different things to try to alleviate pressure or make things not as bad as what they might be, but at the end of the day, it's very difficult to do that. And so because recessions occur from time to time, I want to kind of bring across some different potential causes for them. One of the best ways to do this is look into the past. We're going to talk about some of the past recessions that we've had in the past 100 years and why those occurred, so that we can maybe think about how it might occur in the future. But let's talk about one of the ones that probably comes up most often in people's minds today in 2020, right now in February, early February 2020, and that is this idea of a black swan event. So a black swan event is essentially when something like, say, the coronavirus occurs and people start to get very concerned about it, and this can literally cause a recession. So I'll show you how this can happen here, but let's say that with this virus spreading, and I don't want to scare anybody here, but if the virus spreads to a significant amount of people, if millions of people contract this virus, it can really put quite a damper on not only Chinese economy, not only on the US economy or other economies, but throughout the world, okay? And so we are kind of see this going into motion here a little bit, where looking at the stock market on Friday, so a few days ago, the market dropped about 600 points. It dropped a couple percent, and a good portion of that was because of this fear of, if this virus spreads to millions of people, and if there's a lot of fatalities, and if there's a lot of people getting sick, that's going to put a big damper on the economy and obviously human lives, of course, but it's something that we need to think about. So any type of black swan event where maybe there are tsunamis, there's hurricanes, there's natural disasters, there are earthquakes that can totally ruin an economy. Look at Puerto Rico a couple years ago when they got hit with that massive hurricane. They didn't have electricity for almost a year, and that really hurt the Puerto Rico economy. So any type of natural disasters or things like coronavirus can definitely put a damper on economic growth, and it can really sort of, not just in itself, but people thinking of that happening can cause a recession as well. So even if coronavirus doesn't become widespread where millions of people get it, the thought of it happening instantly makes airlines say, you know what, we're not flying to China anymore, we're not flying out of China either, and then countries start to say, you know, like Italy, saying that they don't want anybody coming in from China. They're putting a barrier there and saying that people aren't allowed in, and so people start to get contractionary. And even looking at China right now, if there's 60 million people who are not going to work, if there's 60 million people essentially on lockdown here, that can definitely hurt the Chinese economy, and we'll probably see that happen in the coming weeks and coming months if this does become worse. Like I said, I don't want to do fear mongering here. I think everything will be okay in the long run, but it is something that we want to be very, very aware of. And even something not as deadly as that virus, but looking at the flu, right? The swine flu, it was 11 years ago, I think it was 2009. We saw 20% of the world population got the swine flu. They got H1N1, right? And when 20% of the world population got this, about 500,000 people died from it. But as a whole, when you think about companies, if they have 100 employees, a random company, say here in Philadelphia, has 100 employees, and 20% of the world population gets swine flu, well, that means that 20 of their employees are probably going to be out for a week from work because they're sick with the flu, and that's going to hurt the company's bottom line. It's going to hurt the revenue, and it's going to hurt the economy as a whole. So any type of viruses, diseases, sicknesses, very sad, very tragic, obviously, but it can also have a bad effect on the economy. So it's one of the ones that we wanted to bring up in this video. All right, so the next one is not as deadly, but it can still have a pretty drastic effect on the world, and that is trade wars. So if you were not living under a rock in 2019, you're probably aware of Donald Trump and China and trade negotiations, trade war. This actually played a pretty big effect on the stock market because people were worried about growth, and if we enter into a very serious trade war, well, that could definitely hinder economic growth for most countries. And so in general, just basic economics here, trade is generally good, especially for the global economy as a whole. And so if countries aren't trading with each other, if they're slapping tariffs on imports and exports and they're putting embargoes and they're not trading with anybody, that's generally going to not have a very good economic effect, and it could stunt our growth in the long term. Now, there are some benefits to it. We can get into that in a separate video, talk about trade wars. But as a whole, I think trade wars, or the idea of entering into a trade war, can really hinder the economy. And we actually saw that in 2019, whenever the fears of a significant trade war, of some type of trade deals not working out, whenever that would come up, it would really kind of put a damper on the stock market, especially. And so trade wars can kind of lead us into recessions if they get very, very bad. But I think this is something that we have likely avoided. We'll see how it goes in 2020. It's not something that on the most of my concerns at the moment, but also just keep an eye on different economies, different countries, and how they're trading with others. So looking at the United Kingdom, looking at England, who just left the EU a couple days ago here, looking how they negotiate trade deals with the EU and with the United States, and kind of seeing how that plays out. It's going to be interesting. It's always helpful to keep an eye on that just to see how it goes, especially if you live in the United Kingdom. It's going to be very, very interesting. So that's another possibility. But let's talk about one that I think happened about, well, it's been 20 years now, which I was 2 years old. I was 1 year old at the time, but it's the dot-com bubble. So the dot-com bubble, essentially what happened here is people sort of started to lose confidence in their investments. So this is number 3 here. It's when people lose confidence in their investments. And the basics of this is that, and this could be something that we're in at the moment. It's difficult to tell until it's too late, but essentially what can happen is if people are investing into companies, into the stock market, and they're very excited, they're thinking about this growth that they're going to see in the next couple of years, but it's too much growth. There's a little bit of speculation in there. So with the dot-com bubble, what we saw is people were investing tons of money, billions of dollars into these companies that would just say .com at the end of it. So pets.com or a number of just .com companies, and they were valued at billions of dollars, even though they were pulling in maybe a couple $1 million, maybe $10, $20 million sometimes, and they were valued at billions. And so there's kind of this gap here where people had such an expectation for massive growth. Essentially what happened is people overestimated the potential for the internet. Now, obviously, we saw so many technological and societal changes 20 years ago during this dot-com bubble, but people got a little bit ahead of themselves. They got a little bit too excited, and when they realized that they got too excited, they started to lose confidence in their investments. People started to sell. What happens when people sell stocks? Well, the price of that stock then goes down, which then may, in some cases, trigger other people to sell, and it creates this chain reaction where people start to sell, and then suddenly the stock price can be down 50%, 80% in a day. And we saw that happen with the dot-com crash in the early 2000s. So just be careful of that. If you're investing into companies where there is a lot of growth expected, where the PE ratios are absolutely insane, I'll give you an example here. Tesla, I think it's a wonderful company, and I think they're going to be doing extremely well in the future. I think it's the company of the future. But there's a lot of growth factored into the stock right now. The stock is worth more than Ford and GM combined, even though they're producing a lot less cars. So there's a lot more that can go wrong there. And, I'm going to be honest, I think it's going to work out for Tesla, but it's still a lot more that can go wrong. And that's essentially, we saw tons of Teslas in the early 2000s, where there are these companies that weren't making a ton of money at the moment, but were expected to make billions and billions and billions of dollars, and people realized, okay, maybe this isn't feasible for all of these companies to be able to do this. This might not be possible. So watch out for that when people start to really lose confidence in their investments, like what we saw with the dot-com bubble. People just got a little bit too ahead of themselves at the time. Okay, now the next one is actually a little bit different from this, and that is a loss in consumer confidence. So this is not investor confidence. This is more so people who maybe don't even have investments. Maybe they don't even know what a stock is. But this is different from investor confidence, okay? So consumer confidence is when people start to lose the ability to go out and buy new things. They might not go to the mall anymore. They might not buy the new car, buy the new house, because they start to get squeezed. And getting squeezed can happen from any area. And this is really important to remember here because it can come from anything. So what we saw happen with the recession about 12 years ago now is the housing collapse, right? So the housing market came crashing down. And when this happened, a number of people, millions of Americans, found themselves where suddenly they didn't have as much equity in their home. Maybe they got a home mortgage for a house that was $500,000 in 2005. And then in 2007, 2008, their house is worth $200,000, $300,000. So they lost $200,000 or $300,000 in the value of their home. So suddenly they feel pinched. And when they feel pinched, maybe they say, you know what? Maybe we shouldn't go out to Applebee's tonight. Maybe we should just cook from home. Maybe we shouldn't buy the new car. Maybe we shouldn't buy that Hummer, even though some people still bought the Hummers in 2008 when they couldn't. But people start to become more contractionary. So consumer confidence starts to fall. People start to say, we need to save our money. We don't have enough money. We just lost a ton of equity in our home. We just got our car repoed. We had a number of things happen. So we need to start being contractionary and stop spending as much money. And when consumers stop spending as much money, it can really put a serious damper on the economy and can start sliding us down into a recession, because if people need less food from Applebee's or going out to restaurants, obviously people always need to eat, but if people don't need those luxury goods anymore, it's going to slash the demand for it, which then suddenly the suppliers, the manufacturers are going to have less demand to put out, and so they're going to have to lay off workers, and it creates this chain reaction that can happen rather quickly, and we saw this happen about 12 years ago. All right, so another potential cause here, and this kind of ties in with the last one. You'll see that a lot of these sort of tie in with each other, and this is because when one starts to fall, many others start to fall as well. I kind of view it as just this line of dominoes, and every domino could be a different market, a different industry, a different niche, right? So you have the housing market, right? And then you have all these other different things in the economy. Well, if the housing market falls, guess what? It knocks over all the other dominoes in the economy. Not in all cases, but this is what happened. It trickled into the rest of the economy, and we saw this massive global economic downturn about 12 years ago. Okay, so the next one here is when people are just borrowing too much. And this is something that you can see in any time during any economy. You can just look at this and say, you know, how much are people borrowing? And when people are borrowing up to their necks, when there are people who are, like what happened 12 years ago, getting home mortgages for $400,000 when they're, you know, a waiter making $20,000 a year, it just doesn't add up. It does not add up. And so when you see companies, banks, financial institutions giving out these massive loans to people who can't afford to pay off these loans, it's definitely a massive red flag. Right now at the moment, looking at something like student loans. Student loans scare me quite a bit. I don't know if this would have a drastic kind of quick effect. I think it would be more so of a slow kind of just like choking of most millennials and most Generation Z who graduate college with $100,000 in debt, and then suddenly they can't go out and buy a house because they have $100,000 in student loan debt. They can't buy a new car. They can't go out and spend any money and be consumers in society because they have this just crippling student loan debt that's going to be with them until they're 50 years old. So that's something that I don't like to see, and I think it's going to have just sort of a long-term just bad effect on the economy, just kind of keep a damper on the economy. But it's obviously difficult to tell. But just keeping a look at all different types of debt. How much debt are consumers bringing on? And when they start to bring on more, what happens here is it can amplify recessions. It can amplify a lot of negative things in the economy, because suddenly if somebody loses their job, but they just bought all this new stuff with credit cards, and they just got a new home mortgage, and they got 2 new cars, they have all these loans, right? And then they lose their job, it amplifies everything. So now they have so much debt and they have no job, they're screwed. This is what happened in many different types of recessions that we've seen in the past, not just in America, but in a number of countries as well, but especially in America with our consumerism ideology that we have here in this country. Okay, so let's talk about interest rates very quickly. And so interest rates can actually have quite an effect on the economy as well. And we can see these literally cause recessions. So we have the Fed, which is this organization, this group of people in America who attempts to try to kind of control the economy is the best way to put it. They try to smooth out the curve so that we continue to see growth in the economy. Now, this does not always work, and there's a lot of cases where the Fed makes a lot of bad mistakes. But what the Fed tries to do is they try to control interest rates so that essentially these rates can play quite an effect on the economy, okay? So I'll give you an example here. If interest rates are very low, it means that borrowing is cheap. It's cheap to borrow, and so this kind of incentivizes people to borrow. So if you can get a home mortgage for 1%, for 0% or 2%, say, right? If you can get a car loan for 1 or 2 or 3%, that's very incentivizing. You say, you know what? There's barely any interest. I might as well go out and get a new car. I might as well go out and buy a new home. So this actually incentivizes people to buy more things. And when people are buying more things, the economy tends to do better over time, okay? And so this is what the Fed likes to do. They like to lower interest rates so that interest rates are very low during a recession. When we're in 2008, when we're in 2009, 2010, right? The Fed slashes the base rate. They slash interest rates down to 0, like what we saw. And so it tries to incentivize people to borrow money, to go out and spend more money, right? But this can also happen when we start to see the economy doing very well. And if the Fed starts to raise interest rates, what can happen here in this case is that it kind of disincentivizes people from going out and borrowing because they don't want the economy to heat up too much. Now, this doesn't always work, and the Fed gets a lot of flack for this because there's times where people, in hindsight, say, you know, the Fed really should have lowered interest rates at this time, or they should have raised interest rates at this time. If I'm losing you here at any point, just leave a comment down below. I'll try to get back to you. I know it can be a little bit confusing, but it's all going to make sense at the end of this video, I promise. So what happens here is, let's say in 2004, a lot of people say, well, the Fed should have increased interest rates. And if the Fed had increased interest rates, then maybe it would kind of slow down this housing bubble where people were just buying houses like crazy. The price of homes were going up at just absolutely insane prices. And if the Fed had raised interest rates enough during 2004, 2005, then it could have kind of prevented this problem. But at the same time, if they raise interest rates too quickly, it could literally cause a recession. I really hope I'm not confusing you here, but it's very sticky. Look into interest rates. Just read about it, read a textbook about it, watch some YouTube videos on it, whatever you have to do to understand how interest rates work and how the Fed can use those to essentially try to control the economy. It's something that's not as effective. I'm going to argue that it's not as effective as it once was because we have quantitative easing. We have a number of other different tools that we can use. Quantitative easing is a totally different video. I'm thinking about making a video on it, about printing money, but I'm not sure how that video would do on this channel. It's a pretty controversial topic. But yeah, let's leave that one to a separate video because that's something that totally could cause another recession as well. So as you can see here, there's a lot of different potential causes for recessions. And I don't want you to get scared from this because I literally just went on for 15 minutes talking about all of these potential things that can happen in our economy. And that's because at the end of the day, I invest for the long term. So I can't tell you how to invest. It's really up to you on how to do this. But if a recession occurs next year, if a recession happens in a couple of years from now, I'm not terribly worried about it because the way that I invest, I like to diversify my assets. I have a number of different things. I might have a little bit of precious metals. I might have money in mutual funds, stocks, bonds, CDs, even just everything all around the board so that if a recession occurs, look, I'm 21. I'm not planning on retiring until maybe I might need this money in my 40s or my 50s or my 60s and 70s, right? If I make it that long. And so I have a lot of time. So if the market goes down, the stock market goes down, well, it generally goes up over a long period of time. There's never been a 20-year span where the market has actually gone down over that full 20-year span. So from 1990 to 2010, it was still up from that point, okay? So that's how I view it. I like to invest for the long term, and so I'm not terribly worried about coronavirus. I'm not terribly worried about trade wars or even too much consumerism to the point where people are borrowing up to their necks. There's a lot of things that can scare you in the economy, but just kind of remembering that in the long term, I think it will work out as long as the economy continues to grow throughout the world over the next 50 years, then I personally should be okay. Now, if I was 58 years old and I was planning on retiring next year, if I was in my 60s and I want to retire next year, then maybe I would personally probably think about, maybe hedging against some of these different types of potential risks, because I might need to tap into that money next year for retirement, right? So if you're older, a lot of older people like to hedge against recessions. They like to put money into safer investments like CDs or money market accounts or even high interest savings accounts. We're actually going to talk about some different relatively safe, and I do those with the little quotations there, safe investments, because everything does involve risk at some point. But we're going to talk about some of these safer investments in a video in a couple of days here. So make sure you subscribe to the channel so you don't miss that video. So thanks for watching the video. Appreciate all the support, and I'll see everybody in next video. I'm really excited for it. So thank you, and I'll see you next time.